Are you concerned that you're not getting the optimal tax break on your investments? Could your investment account have a little bit more opportunity within them? You see, a little investigation and planning could make a big difference. Many professionals know that creating tax efficiency within your portfolio will help you maximize your return, regardless of how the market is behaving. You see, those tax benefits stack up whether the markets are up or down. And sometimes, believe it or not, some of those tax benefits go a long way when the market is down because you can capture some of those losses and use them to your advantage. The tax code is complicated and it's easy to make mistakes or overlook certain benefits. Fortunately, a few simple solutions can help you avoid most common tax oversight. Most importantly, when you're investing and implementing tax solutions, remember to consult with your tax advisor before implementing any of those solutions. So let's start with the first common tax investment mistake, which is underutilizing tax advantage accounts or not using the right ones. So sometimes you have a choice between two accounts. Both are tax efficient, and you're either not using any of them or using the one that gives you less. Let me give you a case in point. You might be using an IRA, but you have a small business on the side. Well, did you know that you could have a different kind of tax qualified account that could allow you more deductions than an IRA? Have you done that? So by not using the optimal investment account, you might end up getting less benefits on your tax return. Another tax mistake people make is using their charitable donation funds in the wrong way. Now, charitable donation fund is something that you can look at as whatever charitable giving you make on a regular basis, or whether it's something you have under a special fund that you created. They're called donor advised funds. And we help a lot of our clients with that. People tend to make cash donations to maximize their return. On the surface, that seems smart. However, donating appreciated stock might be a better option in some circumstances because it could let you avoid having to pay capital gains tax on that stock when it's sold and give you a deduction at the same time. Another mistake people make is having less than optimal investment choices within their account. I'm going to give you a simple case in point, cryptocurrencies. Surveys of investors showed that they were unaware of the full implication of owning cryptocurrency, even after the IRS announced that the capital gains tax applies to cryptocurrencies. For example, one of the major benefits is that the wash sale rule does not apply because cryptocurrency is considered a property. Another mistake people make is that they might be allowing bad investment to be dictated by the tax gains that they would get from that investment. John Templeton, who's a famous investor, said, through reluctance to sell, more than one investor has avoided the capital gains tax but lost the capital gain itself. So don't invest in bad investments just because you're going to get some tax benefits. Tax benefits must also be compatible with the idea of making gains. If you're not making gains and just gaining some tax benefits, you might be missing the big picture. Also, don't forget that dividends are considered income. So stocks that pay high dividends may force your income into a higher tax bracket. This could increase your tax burden. And finally, consider your state of residence and the amount of taxes it charges you. Most of you probably don't have choices, but if you have a choice, you can move into a state that has a lower tax bracket. Some of those states have taxes as high as 13%, and some have zero taxes when it comes to the state tax itself. Federal tax is not going to be affected. This solution applies to some of those people that are kind of residing maybe on the border lines between states. For example, if you live in California, between California and Nevada, say, for example, the Tahoe area, you might be able to move across state line within the same city. You probably might want to choose to have a lower tax rate in Nevada than California. So in summary, to minimize the impact of these common mistakes, start by doing your research, investigate all accounts features before you invest. Only when you're aware of the potential pitfalls is when you proceed forward. Always consult with a competent financial advisor that understands taxes. Many financial advisors do not understand taxes. They only have a generic understanding of them. And vice versa, most CPAs don't understand the investment world very well, and they only have a view on the tax code. So you must work with someone who's proficient on each side. Place your investments strategically when it comes to taxes and make long-term plans. Remember, protecting your investments is important. However, if you're not tax efficient, you're not making the most of these investments. Always consider your tax strategy. Use tax efficiency to help you maximize returns on your investments to give yourself more freedom in the future.